Hello and welcome to this first module of ACE 444. Hopefully you're listening to this and this is an introduction to financial markets. Again, this is an online module and you will be listening to a number of these each week during this semester. By just a little bit of housekeeping here, if you look at to the left of the screen, you will see a list of slides. If you click on any one of those slides, you can move forward and backward and repeat any one of these slides. So you might want to just play with that a little bit and see how you can move forward and backward. Again, another welcome to the class, and I hope you do enjoy the class. I enjoy teaching the class. I do like the material in this class. Financial markets are very interesting, and during this semester we'll introduce you to some of the more interesting, I guess, news of the semester, and there's undoubtedly will happen. Some news will occur during the semester that will impact portfolios. My objective in this class overall is help you pick a portfolio of assets that meets the goals of a particular individual, and that could be yourself or an institution. You could be working for someone else or another person and picking a portfolio or helping them pick a portfolio that meets their needs. Obviously, when you're picking a portfolio, you need to know something about the goals of the individual or the institution, so that comes into play. How much risk they're willing to take and how long they're willing to keep that investment made, or are they looking at the short term or long term. All of those things will have an impact on the portfolio that is picked. Again, what we'll be doing here is looking at that portfolio selection process, as well as looking at some of the information and news that impacts how those decisions are made. Again, the overall objective is to pick a portfolio that meets the needs of an individual or institution. We're going to begin at the basics, and that is, what is a financial asset? And these financial assets are what fit into the portfolio of the individual, and those financial assets can include many different things, and you see a number of examples here on the screen. The first four of those: bonds, a bond issued by U.S. Department of Treasury; GE, or corporate bond, or a bond issued by the state of California; a municipal bond, bond issued by a government of France, which in our case would be a foreign bond. All four of those bonds are items that we'll talk about as we're moving through the course. Another or a couple more are examples of financial instruments are automobile loans and home mortgage loans. Both of those are made and can be and have been held by individuals and institutions. And by the way, automobile and home mortgage loans typically aren't held, or the asset isn't held by the individual, but by an institution. Although they do sneak into portfolios, particularly if you have an investment in a managed portfolio, those may be in there. Final two items are common stocks, and Microsoft Corporation and Honda Motor Company are two examples of those. As we're moving through this course, we're going to be talking about picking common stocks, or our first module will be talking about stocks. So that will particularly deal with Microsoft Corporation and Honda Motor Company. And then bonds will be our second module. So we'll specifically deal with U.S. Treasuries, corporate bonds, and municipal bonds. Those are listed there. And we'll talk a bit about automobile loans and home mortgage loans in that bond sections as we're moving forward as well. In this class, we are going to focus primarily on publicly traded assets. And these are assets that are traded on public exchanges, and anyone can conceptually purchase these assets. So we're going to focus on publicly traded assets. That doesn't mean that an asset that is not publicly traded isn't a good investment, but we again are going to focus on publicly traded because they are available to all individuals. What that does mean is that there is, or usually is, a secondary exchange in which those assets are traded. And for stocks, the examples include the New York Stock Exchange and NASDAQ, National Association of Security Dealers Automated Quotations. We're looking at those secondary exchanges. In fact, most of the time when an individual purchases an asset, they're purchasing that asset from a secondary exchange. That means that they're, for example, let's take the case of Microsoft Corporation stock. They aren't buying a new asset or a new piece of stock. They're buying a stock from a secondary exchange and purchasing that asset from somebody else. They don't necessarily know who that individual is, but they buy it through a secondary exchange. No need to know the buyer or seller in that case. That also means that we'll be generally following prices after the initial public offering. I'm going to take a little time here on these next two slides to specifically just mention a couple examples of the secondary exchange and an IPO, just to give you a couple of examples of that, and that have been in the news here of late. Occasionally, the exchanges themselves make the news, and last Friday, in fact, NASDAQ was in the news, and not in a manner that the owners of NASDAQ, which is a publicly traded company, would enjoy it have occurring. NASDAQ is a electronic market in which stocks are traded. Microsoft, for example, is traded on NASDAQ, or the electronic trading system. For whatever reason, last Friday, there was a halt in trading for approximately 2 hours. Made big news. That isn't generally viewed as a good thing. Halts in trading are generally viewed as very bad because it reduces the transparency of the market, and it could cause major disruptions in the market and the positions that people wanted to take. The exchanges themselves, NASDAQ, New York Stock Exchange, and the equivalent bond exchanges, come under a lot of public scrutiny and a lot of regulation as well. The exchanges themselves, NASDAQ and New York Stock Exchange, would fall under the regulations of SECs, the Securities Exchange Commission, amongst others as well. But the public interest in these trading services comes into question, and it's a matter of transparency and fairness. In the past, there has been some interest or concern that some of these exchanges were not fair to the small trader, for example, or gave a lot of advantages to large traders. So all of those issues come into scrutiny, if you will, when these exchanges occasionally have hiccups. Again, this class is going to primarily deal with not initial public offerings. And again, most of the time when you're buying a stock or a bond or a treasury, you will not have the initial public offering, but will be trading in the already existing share on exchange. Occasionally, IPOs, or often actually when IPOs become public, they make the news. One example of this that you probably may have heard of was Facebook, and Facebook had an IPO a little over a year ago now, May 2012, and that IPO came under a lot of scrutiny as well because of the dramatic fall in the stock price that happened immediately after the initial public offering. The way initial public offerings work is that investment bankers come up and make sales of the stock originally to other institutions that then will try and market those securities to other individuals or get it out into the public holdings. Generally, those investment bankers come up with what they believe to be a realistic market price for the IPO. So investment bankers or whomever was underwriting the Facebook uh, initial public offering came up with the price for the share of that IPO stock. After that, on a certain specified day, public offering begins, and the exchange, the stock begins to be traded on the exchanges themselves. In the case of Facebook, the initial price was too high, and the stock fell pretty dramatically, as will be illustrated on the next slide. This slide, or this overhead, or this graph, shows Facebook stock price. Again, we have our first reading on that Facebook stock price on May 18th, 2012. First day it was publicly traded, and we have these stock prices all the way up to August 18, 2013. If you go to May 18th or 2012, or all the way to the left of the graph, you will see there that the Facebook stock began roughly at $40 per share, and that was pretty close to what the suggested price for the Facebook share was, and then just dramatically fell. It continued to fall, reaching roughly a low of $26 a share, then made a slight rebound, but then in August of 2012 it reached its lows of $20 per share. So, in the process here of the initial public offering, if you had bought that share from the investment banker at $40 and ended up with a share that was worth in September of 2012 $20, you've lost roughly half of the value of that stock, and it wouldn't have been a pleasing experience. As you can see, and again, that Facebook stock, hopefully what happens on an initial public offering is that there's not too much variance between what the investment bankers say that the initial price should be and what it actually turns out to be. If there are divergences, something went wrong, and something did go wrong in the Facebook case. As you can see there, then Facebook languished around roughly at the $25 level, but here recently it finally got back to $40. So last August 18, 2013, Facebook price was over $40. That made the news as well that Facebook's stock price finally was above the IPO price. So we have financial assets, and they're traded on financial markets. In the above cases, we had NASDAQ, which is a financial market, and that NASDAQ market sets prices or aids in setting the prices for the assets, or it's where it's traded. And we had an example there of Facebook when it hit the financial market or the secondary markets. Its price differed from that which was originally offered. There are three roles for financial markets. First, it's aid in setting the price of the assets, and that occurs by the market itself. Buyers and sellers of those assets determine the price. The second is to provide a mechanism to sell and buy an asset. A little earlier in this module, I said that you most of the time would be buying and selling financial assets, or most individuals do, on a trade or in a stock market, and they don't even know who they have bought it from or sold it from. Every time an individual buys a financial asset or a stock, somebody else had held it up to that point if it's traded on a secondary market. But the secondary market makes it such that you don't even have to know who that individual was. Because you don't have to know that individual, and you trust the market to provide a efficient and low-cost method of making those exchanges, it does provide a efficient way of trading that asset. The final thing that the markets do is reduces searches and information cost, and a good example of that is go now. Find a stock. If it's publicly traded, you can find what it last traded at up to the minute, and so there's very little um, doubt about what a stock or a bond is currently worth, because all of that information is available publicly. The assets themselves also have important functions, and you see those listed here in 1 and 2. It allows parties to transfer uh, funds from one to another. One individual that has surplus funds can use the financial asset to hold those funds in an asset that generates itself a return. The other role that a financial asset does is it redistributes the risk. And stocks have a particular uh, risk profile. Bonds have another risk profile, and there's other um, ways and means that those assets and the risk thereof can be traded. Derivative markets, for example, futures and options markets transfers um, ways or the risks that are being held in those financial markets. Again, one of the guy gave here a rather simple example. Firm A needs $1 million of funds. They could either obtain that as stock or an equity or as debt. Stock is a residual claim, higher risk, but a claim on earnings. Debt is a specific claim. It has a specific set of payments associated with it, lower risk, and no claim on the value of the firm. As we move forward through time here, stocks and debt, we will look at valuation methods of those two, and they do differ. Stocks, we're always looking at what is the discounted cash flows of that firm or that stock, and that requires looking at the future and making some estimate, if you will, guesstimate of what the earnings will be from that stock. On the other hand, debt, we're simply evaluating default risks. We have a schedule of payments, and we're trying to determine is what are the chances of meeting those payments. If the firm meets those payments, they are not in default. If they don't meet them, they're in default. So we're looking at the chances of default. Financial assets are divided into two broad categories, or there are two broad categories of financial assets: equity, i.e. stocks, and debt. Equity, it obliges the issuer to pay based on earnings. We're going to make dividend payments on stocks based on future earnings. There is no commitment to make those dividend payments. The stock or equity represents a residual claim. There is more risk with equity than there is with debt. But with that risk comes a chance of higher rates of return. If the company that the equity is held in does well, that equity will increase in value. Debt gives a holder a schedule of fixed payments generally, and we'll talk about that a bit more when we get to that standpoint, but it's generally a fixed payments, and then there's no upside there, there's only downside. There are also derivatives, which are based on underlying financial assets. Futures and options contracts are one of those examples. There also is, in some cases, not a clear distinction between equity and debt. Preferred stock would be an example. Preferred stock has some characteristics of equity and some characteristics of debt. This graph comes from the reading that I assigned for this week, the McKinsey Global Institute. Again, this is available on our Compass website. Title of this article is Financial Globalization, Retreat or Reset, and it pretty much gives a nice feel for what's happened to financial assets holdings around the world in the various categories that you see listed on this graph. This graph shows those assets from 1995 through 2007, 8, 9, 10, 11, and the last reading we have is in 2012. You'll notice a pretty major inflection point. Assets were growing from 1990 through 2007. 2008, there was a contraction. 2008, the Great Recession, the financial meltdown, which was a worldwide phenomena. Saw some meltdown there, and financial assets have grown from that point forward, but at a slower rate than in previous times, which probably you can take as an indication of any one of a number of things, but just slowness and growth over the economy compared to the pre-2008 period. Let's really focus on that 2012 bar, $225 trillion. So that's the amount of assets that McKinsey measured at that 2012 date. You can see there that they're divided up into equity, government bonds, financial bonds, corporate bonds, securitized loans, and non-securitized loans. Equity, $50 trillion. These would be the stocks of companies that are traded on those exchanges. So this would be stocks, and this may come as a surprise, but the equity portion of the total market, if you will, total financial asset market, financial assets that exist out there, is much lower than the debt side of things. You can see there government bonds. This would be U.S. Treasuries, French Treasuries, Euro Treasuries. Those treasuries would be listed there under government bonds. Financial bonds would be bonds of financial institutions. Corporate bonds would be corporate bonds of Microsoft, etc. Securitized loans would be items like home mortgages, anything backed by the security of the underlying asset, then non-securitized loans. Now, as we go through this course, we'll be talking about each one of these categories. Equities will be Module 1, our focus on Module 1. Then government bonds, financial bonds, corporate bonds, and those loans will be in Module 2. Again, it may come as a bit of a surprise, but the debt side of things is much larger than the equity side. I'll also point out there that those securitized loans, those would include home mortgages. You'll note that, relatively speaking, it's a small piece, but that small piece is what caused a lot of the 2008 meltdown, the underestimating of risk associated with home mortgages in a securitized loan setting. That came to pass to cause large issues and precipitated some of the financial problems. Might be surprising to note that it's a relatively small piece of this total bar here. Again, though, just gives you a feel for the size of loans that exist out there. And again, read this that article. It will give you a pretty good feel for what has happened in financial assets over the last several years. Putting some more meat to those divisions, or more finer lines to those divisions. We had equities, debt, or bonds before. Now we've divided those up into more detail. Equities would still include common stock, and then we will further divide those into growth values, small cap and large cap. Bonds, and now we've mentioned debt before. We've divided those out into bonds and commercial paper. Bonds are generally longer length, although not necessarily so, but have scheduled interest payments, and those would include treasuries. U.S. treasuries will be the one what we're looking at. Corporate bond, which would include financial and other corporate bonds from the other other slide, and municipal paper. When we'll talk about all three of those, we'll talk a little bit about Chicago municipal bonds and Detroit municipal bonds, which have made the news here of late. And the final one is commercial paper, and this is short-term unsecured debt. If you held a money market, which many of you may have held, is actually backed by commercial paper. And again, we'll talk about all of these as we're moving through this course. The previous slide talked about equities and bonds. Often those are bundled together and then sold to investors, and those often happen through mutual funds and exchange traded funds. A mutual fund, for example a stock mutual or fund, would hold stocks of individual companies, and then investors would purchase and sell shares of that mutual fund. And there's all different types of mutual funds and exchange traded funds. Many of them make it more easy for an investor to hold specific desired or diversify their asset holdings, but it's a way of holding assets in a bundle, and the holding firm, or the person that the firm that originates those mutual funds and exchange traded funds, is offering the bundle to investors, obviously in exchange for money. Their hope is to make that money on those funds through the fees and other items that are associated with those mutual funds. Again, we will be talking about mutual funds and exchange traded funds as we move through this semester. Throughout this semester, what we're going to be doing is looking at financial assets, stocks, bonds, derivative markets, commercial paper, bonds, equities, often held in mutual funds or ETFs, and looking at ways of building portfolios using those items. Just as a note here, again we're talking about portfolio, an often made suggestion is that an individual start as the basic point of holding a portfolio that consists of 60% of its funds in stocks, 40% of its funds in bonds. The stocks add growth. The bonds usually are thought to offer stability, and often made advices to diversify among investments. So when we're holding stocks, we would want to hold a bundle of stocks, or a number of those stocks, so that we can diversify our risk. Again, we've completed Module 1 here, looking at the financial assets. We'll be moving on to measuring returns from those assets in our next module.